trend can run much further than just about anyone thinks it can at the time. A lot of trends don't. But when a trend does start to run, if you can enter that trend and then have strategies that help you stay on it whilst it's moving, that gives you the potential to make a lot of money.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. We've spent a lot of time on this podcast discussing value investing and researching companies based on numbers, haven't we, Jason?
Have indeed, yeah.
But there's another way of looking at the share market, and it's known as technical analysis. It's those charts that you see showing the history of the price of a share or index. There's a multitude of lines, indicators, patterns and signals, and they quickly become overwhelming. However, in their simplest form, some say that they convey information that's very important. Hence today's guest, Jason McIntosh from Motion Trader. Hello.
Phil, thank you for having me on the show. I've been really looking forward to being a part of what you do.
Yeah, we've been talking about this for a little while, haven't we?
We have. Yeah, you've got such a great diverse range of guests you have on board.
Jason, you're the founder of Motion Trader, a subscription-based trading service for ASX-listed stocks. But you started your time in finance at Bankers Trust. Do you remember what it was like as a young man walking through the door and embarking on that career in finance?
Yeah, Phil, I remember it like it was yesterday. You see, I was doing my last year of university and I'd landed this part-time role at Bankers Trust after uni each afternoon. And so I was going to work on the bond desk in the dealing room. And so I'd never been in the dealing room before. I had all my interviews in another part of the bank. And my first day, I remember it so clearly. I was in the lift on the way up to level 40 of Australia Square. And I could feel my heart like beating, running, and beads of sweat were rolling down my side. And so the lift doors start to open and you could hear the hum of the trading floor. And so I step out in the foyer area, start to walk around into the opening, step into the dealing room, and I'll tell you, it was like setting foot on another planet. You got guys, they're standing up with a phone to either ear. You got other guys that yelling over to colleagues on the other side of the desk, guys pointing at screens with flashing numbers, and I'm like, where on earth have I just landed? This is just amazing. It's like I'd seen Wall Street, the movie Wall Street back in 88, and that's got some good dealing room scenes there. But what I was in now, it was like something straight out of the movies, and it was like, wow, this is where my career's starting. This is great.
And when you first arrived there, they basically said just make money. That was your metric, your key metric, wasn't it?
Yeah, it's funny. When I got my graduate job, the head of the dealing room said, Jason, welcome to this side of the revolving door. And by that was a reference to that they had a high turnover of people in that dealing room. It's like, here's your seat, sit here, make us money. You make us money, we pay you well. If you don't, well, you kind of had to go somewhere else. And so you had like a stable core of traders who'd been there for a long time and made the bank a lot of money. But then you had this outer layer where people were coming and going fairly frequently, hence revolving door.
So what were you doing? I mean, they just say make money. And did you have any idea of how to do that?
Yeah, well, I did. I had a bit of luck on my path through Bankers Trust. So I started off doing my part-time role when I was at uni. And look, I must have done a fairly good job at doing that. And I came up with a few new ideas to streamline some processes they were using. So the head trader, he said, look, I hear you've done well, so let me ask around for you. And he came back a couple of days later and said, look, I've got two heads of department that would like to have a chat to you. One's the head of the futures floor and one's the head of the charting department. So this is where I got my training. And you see, the charting department, when I look back, it was the ideal place to start a career in financial markets. So the guy who ran the department was a guy called Scotty. He would have been mid-30s, tall, sandy blonde hair. He was a surfer. So he's not the classic type of investment bank analyst I think that people picture. But this made him unique in that he had this free-flowing approach to the markets, to looking for patterns like he would for looking for a wave on the surf. And he was always telling me it's not about what will happen, it's about what could happen. It's about looking for possibilities and probabilities. And that's how he started getting me thinking about markets. And he said, look, Jason, there are 3 phases to the market. There's an up phase, a down phase, and a sideward phase. And he said that if you can identify which one you're in, then you got the potential to make a lot of money. And, that really got my interest. And so, it's through his influence and teachings that I started to learn about the financial markets and about how markets move and how trends are formed and how you identify them. And that set me on my course. From then on, I was focused on looking for trends in markets, using price data, and then learning all the the psychological aspects to being able to put together a trading approach, an investment approach, and make money from it. So look, I was lucky. I was in the right place. I had brilliant people around me to learn from. A lot of us have to learn from books. I had books plus the guys who are there in the trenches actually doing it. So sometimes luck goes your way and you make the most of it.
Because technical analysis is a broad church, like, patterns as well in the traditional style of technical analysis where people would be looking for pennants, and you're not interested yourself in any of those kind of patterns?
That was my initial training. I'd look for things called pennants and flags and wedges and triangles and rectangles.
Yeah.
Head and shoulders.
And these are lines drawn over patterns
so
on a price chart.
Well, back in those days, you'd print the chart out and you'd get the ruler and the pencil and you'd be drawing the lines on it. And I've still got time for that sort of thing. I don't actively seek out those patterns anymore. I've just taken a different approach. But the concept that a market will move in one direction and then move sideways for a period, that's a consolidation. And that's where you get those patterns like triangles and rectangles. So whilst I don't look for them as such, I do recognise a sideways period within an upward trend. And when the market will then start to move out of that consolidation, that's when maybe you'd get a point to buy an interest stock and then stay with that trend while it runs. So the underlying principles of all that are all fine. But look, I'm not drawing the same sort of trend lines as I once was. Not that they don't work, but it's a lot more discretionary. What I'm doing now is more analytical and consistent in terms that I'm using data and treating that data the same way each and every time. And I think that's what throws a lot of people off with technical analysis, because it is discretionary. And I've seen people draw lines on charts and you go, what is that doing? It doesn't mean anything. And technical analysis, again, it's such, as you say, it's a broad church, and that would include everything from guys who are using lunar cycles to sunspots to.
There are some that do that, don't they?
There are. It is it's wild and wonderful out there in terms of what people do, and a lot of it is nonsense, really. But it comes under this broad banner of technical analysis. High frequency algorithmic traders would also be classed under technical analysis, and they're very different to the sunspot guys. So it's vast and broad, and what I do fits under there. So for me, it's all about identifying trends and exploiting the advantage that entering a trend and staying on a trend can give you, rather than there's like Elliott wave theories and Garn approaches and all these esoteric things which are
Bollinger Bands, and
they get very convoluted. They may work some of the time, but some of the time isn't really. Look, it's about finding a process that gives you repeatable success. And I think some of these ones which are quite, one person will think one thing and one will think another when they look at it, it's hard to get repeatable success with that sort of framework.
You mentioned previously support and resistance. These are very basic concepts in analysing a chart, aren't they? Yeah,
that's right. They're not things I use so much anymore. But a lot of chartists will look for that. They'll look for areas where the price has historically struggled to go higher from,
and that's resistance.
That would be resistance.
Yeah.
Typically around a previous high. They'll say a previous high will be resistance. And if the markets run up to that previous high a couple of times and fail, then they might say, look, that's a double top. So there's extra resistance there now. And the theory would be, well, if the price breaks above that area, well, then it's a breakout, and momentum then shifts to the upside. The opposite applies with support. If a stock has fallen to a level and then rebounded and maybe has come back and tested that level on other occasions, you say there's support, there's natural support for the market there. Buyers are coming in to hold the price at that level. And if it breaks below there, well, then support breaks and then you look for another leg down. So the underpinnings of that sort of rationale is all, look, I think it's all quite solid. And it's something which a lot of look, a lot of everyday traders can do. They can get some good technical analysis or charting books and understand those concepts and sort of like see how they work and why they work.
And you're really looking at the basics of the trend. Like you mentioned before, that there's markets are either going up, they're going sideways, or they're going down. You're looking for those trends, aren't you?
Yeah, well, the trend's key because like a trend can run much further than just about anyone thinks it can at the time. A lot of trends don't. A lot of trends don't go too far, but when a trend does start to run, if you can enter that trend and then have strategies that help you stay on it whilst it's moving, and then strategies that help you come off it when the trend starts to lose its momentum and turn lower, well, that gives you the potential to make a lot of money. It's called asymmetric risk is what I look to do with a trend. So like you just think back to geometry at school. Symmetric is when one side's exactly the same as the other. So if you take symmetric risk, you're risking $1 to make $1. And that's a hard thing to go forward and make money in the markets from. So we look for asymmetric risk. That's where you may risk $1 to make $3. And with a trend gives you the opportunity to do that because you can buy a stock, take a position, have an exit level which is at some point below the market. You might use a percentage, or like I use percentages to do these things.
So that's a stop loss below which if it drops down you say, okay, well...
So say you use a 20% stop loss.
Mm-hmm.
So I'll say, look, a stock has broken higher. It appears to be in the early stages of a trend, so I can buy it here. I can have a stop loss maybe 20% below the market. Now, I don't know how far it's going to run, so I don't have an predetermined exit level on the upside, so I'll let it run until it stops running. So that could run 5%, 10%, 50%, 100%. There have been some stocks I've been on which have run 500%. And so that's the asymmetric part because I've initially risked 20% and I've potentially made a triple-digit gain or a large double-digit gain. So if you play that game over and over again, you're not going to win every time, but you're putting the potential to get these outside gains in your favour, and whilst minimising your risk, which is a key part of a successful process.
Heads I win, tails I don't lose too much.
Heads you win 3 times what you might have lost if you got tails. That's the game of two-up you want to play.
Yeah, that's right. So you use a very simple chart showing moving averages. Can you give us a really fundamental explanation of what a moving average is?
Yeah, it's funny. The longer I've been in the game, the simpler I've become in my approaches. So, like if we spoke a little earlier ago about things like these technical indicators which people use, and they all sound very complicated, like things like Bollinger Bands you mentioned. Yep. There's stochastics and oscillators and
RSIs and MACDs and
pitchforks. There's all manner of weird and wonderful things, and
Fibonacci's as well.
Fibonacci's is all part of Elliott Wave. So these are all things which I've used over the years, and I've found. Look, I haven't found that any of them really provide a consistent edge to making money. They work sometimes, they don't work other times. I've done back testing where I've used lots of data to see whether these indicators really work over time. And look, maybe some people can make them work, but for me, I haven't really found anything special about them. They look good when you see things in hindsight, but they actually use them in real time. It's a little bit harder to get that benefit. The moving average, though, like if I was to use one indicator, the moving average would be my go-to. So now what a moving average is, it's simply an average of the closing price of a stock over a certain period of time. So we say 50 days, for instance. So a 50-day moving average will take the closing price over the last 50 days and average it, and that'll be the first data point.
And it appears as a line against the price.
That's right. It'll be a smooth line that is either above or below the share price. If the share price is rising, the moving average will be below it, and that shows that the price is above the moving average, so it's in an uptrend. The opposite applies when the price is below the moving average, then it's said to be in a downtrend or in a bearish phase. So it's a really simple way of quickly identifying what phase the market could be in. Is it bullish or is it bearish? And each day, the 50th day price will roll off and the new day's price will come on. So it's a constantly changing average price, hence the moving average. And look, I've used moving averages on 5-minute charts, or I've looked at them on monthly charts. You could even do them on yearly charts if you have enough data.
Okay, so just stop there for a second, because people most probably don't understand the kind of durations that charts operate on. Like when you first open up at a chart, I think most of them will default to a day period, won't they?
You'd see a daily chart, yeah.
A daily chart, but these charts can go all the way down to 1 minute.
Yeah.
And then all the way out to years of charting.
Yeah, if you have the data, you can go out to years. And it is an interesting thing to look at a chart over more than like a 1 year time frame. 1 year is really just a snapshot. So I like to, I'll look at what's happened over a year, and then I'll, look at what's happened over as much data as is available, be it 10 years or 20 years, depending on what the.
With a moving average against it?
Oh, look, probably not with the moving average over 10 years, because it's more just to get a broader picture of what this stock has done. A lot of the time it's just out of interest to form a big picture view of it. I'd use the moving average, usually just over the 1 year period to see, look, where are we currently? I listened to this really interesting interview a little while ago with a guy called Perry Kaufman. Now he's an American algorithmic trader. He's one of the pioneers in the area. He started life as a rocket scientist. So we use the term rocket scientist to describe someone who's really clever in finance. Yeah. This guy literally was a rocket scientist, and he was talking about how they used moving averages in the guidance systems of missiles back in the 60s or so when he was involved in that area. And I just thought that was amazing, because that's kind of what I'm using a moving average for now. It's such a simple indicator, but it can be used in such complex tasks, as in guidance systems for missiles, or in helping to eliminate 1,500 stocks from your field of view. As I said, look, if there was one indicator, that would be my go-to. Anyone starting out in the market who's trying to understand like what a trend is, you get up a chart, you put on a moving average, and it kind of paints the way for you, leaves it's your trail. It's a trail that sort of shows you, is the price going up, is it going down, based on the direction of that moving average and where the price is relative to it.
Are any of your videos available with this kind of demonstration?
Yeah, look, I talk about, I've got a 4-part training series which I make available on my website. Mm-hmm. And that talks about the moving averages as well as some of the other processes that go into it. Because look, there's more to a trading strategy than one indicator.
Yep.
It's one piece of a multi-piece puzzle. And but look, the training series is good because it goes through all the pieces and it brings them together. Because that's the key thing a lot of people don't get, I think. I often talk to people who they've found one part of a good process. Maybe it's often the buying part. They've often found a good way to buy stocks. But there's so much more to it. You've got to work out, well, when you're going to sell a stock, that's actually the hardest part, I think. Lots of people tell you when to buy, not so many people tell you when to sell. And this is where a lot of people get into all sorts of bother. Like I see people, they sell their good stocks too early, or they hold their losing stocks too long, or maybe they hold their good stocks too long. They ride them all the way up and then all the way back down. And I've seen that happen more than a few times where people have had these. I've seen some massive gains. People have made multi-hundreds of %. And you talk to them a couple of years later and they go, oh, geez, I gave it all back and now I'm in the red because they just didn't know when to sell. And it's not because they're just not clever people. It's like selling's emotional. It's hard because you're crystallizing a loss. You're locking in a loss, which makes it a permanent loss, and people struggle with that. Or they're jumping off a big profit when greed might say, look, I should hang in there and get more of a profit. It's a very emotional time working out when to sell something. So that's what the video series helps with. It goes through all the facets of the process.
So the moving averages, you just don't depend on just one. You like to see crossovers, don't you, between a couple of moving averages. Yeah. If I can just put in here as well, I've recently learnt about the golden cross, which people in the United States, apparently it's a very common system where two moving averages cross over each other, and that's used as a signal to buy or a sell. Have you heard of the Golden Cross?
Yeah, they've also got the Death Cross.
Oh, and the Death Cross.
The Death Cross. That's a bit spookier. It's yeah. Look, this is all these funny names probably doesn't do technical analysis much justice. Like, what moving average? What periods are they using? So there's all different periods that you can use. I don't know what they're using, whether it's 100 days and 200 days. Yeah, look, I use two moving averages. I use a 50-day and a 100-day. Now, there's no magic number in any of these days. If you're a short-term trader, you might use maybe a 5-day and a 20-day moving average. I use the 50 and 100 because they're good medium-term trend following type periods, but you can use longer, shorter. You could use 40 and 80 and it still gives you a similar sort of outcome. There's no magic number to these, but I like the crossover because when the shorter moving average moves above the slower moving average, that's telling you that the momentum shift to the upside. So you could get that from a single moving average as well. A dual moving average isn't essential by any means, but it works well for what I do.
Mm. And some people just use these as opportunities to find a stock that might be going in the right direction, and then they'll apply fundamental analysis to see if it's worthwhile investing in as well. It's not necessarily just a signal, okay, this is the time to buy and this is the time to sell. It's not necessarily just for that.
Look, a lot of people make the mistake and think that it's two camps. You're either fundamental or you're technical. But that's not right, because a lot of people have success by combining the two. You're using aspects of both of them. So a lot of people I hear from who use my service, they use the price analysis, the technical side, to identify opportunities, because you've got 2,000 stocks out there. Your top 50 or so are easy enough, but how are you going to find some of the smaller to mid caps, which you probably don't know their name? This is where the price analysis comes from, because it can identify them. Because any stock that's going higher has to trend, has to rise in price. And it's a bit like, think of trying to spot a plane in the blue sky when it's at 30,000 feet and you're on the ground. It's next to impossible unless it's leaving a vapor trail. Leaves that vapor trail, spot it straight away. Similar with a rising stock, the rising price is a stock's vapor trail, and that's how you identify a rising stock, a stock in a trend. And then once you do that, well, if you're like me, you just go with that. I'll buy a stock which I don't know, I don't need to know, and I'll put risk managing strategies around that. And if it keeps rising, I'll keep it. If it falls, I'll cut it. Not everyone does it like that. Others will get a list of stocks which are rising, and then they'll apply a whole lot of fundamental filters, and they'll look for whatever it may be that they look for, whether it's growth or value or dividends. It's there's a whole array of fundamental things you can do to analyse a stock, and that's when the two can work really well.
Okay, you've started investing in the stock market. Now, how do you track trades, dividends and distributions and all those other goodies? Throw away those clunky spreadsheets with ShareSite. I have my portfolio in ShareSite and everything is automatically recorded. ShareSite is pleased to extend a special offer to listeners of this podcast. Save 4 months on an annual premium plan. Go to sharesite.com/shares for beginners and sign up now for a 7-day free trial before taking advantage of 4 free months. That's sharesite.com/shares for beginners. You mentioned before the pitfalls, the emotional and psychological pitfalls. What are some of the things that investors should be looking out for?
Yeah, look, emotions just play havoc with investing. So, you've got the ones like overconfidence and euphoria, greed. You'd class fear of missing out. That's another one which you'd put in this basket together. And those 4 emotions encourage people to take on too much risk. And in investment markets, no matter how you approach them, whether you're fundamental, technical, you're combined, if you take on too much risk, like risk is a funny thing. Risk is great when the market's going your way. You can make a lot of money. But when it turns against you, risk look, if you've got too much on, it can quickly destroy your portfolio. It just pulls it apart, and that's when people just go completely bust. There are so many stories of even banks going bust due to having too much leverage. It's a common tale, and it happens with individual investors, often with margin accounts, take on too much risk. So those emotions you have to be aware of so you don't do that. The emotion of discouragement, where you may have a really good approach to what you're doing, but you might have a series of losses. You might get 6, 7, 8 losses in a row, and you start to question, look, am I doing the right thing? Is my approach actually working anymore? And this is when a lot of people, they've changed their strategy, they sacked their advisor, they switched their fund manager because they've had maybe could be a series of losses or a couple of bad quarters, and they're quick to move on due to discouragement, being fed up. And what is important to understand is that markets often take time to do their thing, and no strategy works in every part of the market cycle. So you often got to sit through a period of lackluster returns if you've got a robust system and have confidence that it is going to work out your way. If you stay with it, you've got to stay with it. And then you've got the emotion of anger, and this is where people they want to get even. So they've lost money in a stock, and they say, this stock owes me money. I've got to get my money back from this stock. But the stock doesn't owe you anything. It's just a stock. But people get they take it personally. And I had a call from a relative. He called up recently and said, look, I've got these shares in Woodside. I bought them last year, so I've held them all through the COVID plummet in the share price, and I'm thinking of buying some more. I want to average down. Averaging down, it's such a dangerous strategy. When it works, it's great because you lower your average and you get back to even quicker. But when it doesn't, it can snowball into a bigger and bigger loss, and that does happen. If you just want to get back out at even, just move on to something else and put your capital into a more productive idea, which is actually going in the direction of it's going to make you money, rather than messing around with something which you just want to get even with. So I think a lot of people approach the markets with the wrong mindset. And it's interesting, you look at the things that make us successful in everyday life, it's things like being right and winning. So in most career paths, you're rewarded for being right. You look at say a doctor or an engineer or a pilot. It's all about being right most of the time. And then people come to the investment world, and all of a sudden it's, well, if you're trying to be right all the time, you're heading for trouble, because the markets don't care what you think. The markets are going to do what they're going to do, and you've got to be prepared to take lots of small losses along the way if you're going to get the big wins over time. I'll tell you this interesting story. It's a funny story. It's at a wedding years ago. It was back in the 90s, late 90s. I was at Bankers Trust, and I met this guy who he worked at a telco, and he wanted to get into the markets as a full-time trader. It was .com time. The .com boom was on. Everyone was talking about the markets. He heard I was at BT and wanted to know all about it. And he said, hey, what percentage of your trades make money? And without giving it a second thought, I said, about 40%. And there's this awkward silence. And I've gone, what did I just say? And then it's dawned upon me, it's like me saying 40% win rate. He's thought that I'm saying I'm actually not very good at this, and I'm probably going to lose my job soon, so don't listen to me. But then, look, I figured it out, and I explained it to him. I said, look, 40% is actually quite normal in the dealing room environment, because my average winning stock will make $3 versus my average losing stock, which will lose $1. So I got this 3-to-1 reward to risk ratio. So you don't need much more than 40% win rate to make a lot of money. And then it all made sense. And George Soros, we've spoken about George's quote before, where he says, it's not about whether I'm right or wrong, it's how much I make when I'm right, how much I lose when I'm wrong. And people don't get this, that they've got this concept that you've got to be right. And it messes with people's heads, and it makes the emotional side of this investment process really, really difficult for people. And unless you don't know until someone teaches you, or you learn about it. it's a very hard trial and error process to pick that up. And that's why for anyone starting out, it's really important to read widely and listen to people who have been in the markets and learn. It's a good way to fast forward your learning process rather than trying to just do it through trial and error.
And you wouldn't want to go see a doctor that was right only 40% of the time, would you?
No, imagine getting on a plane with a pilot who only gets 40% on the runway. It doesn't work. And investment world though, it's completely different. Some of the most successful people in the investment world are right 40% of the time, thereabouts.
So tell us about Motion Trader, the service that you offer.
So Motion Trader is, it's like what we've been talking about. Like it's an algorithmic process that I use, and I've taken a set of investment rules, which I've used for years, and I've converted that into computer code. So that's basically what an algorithm is. So it's a whole lot of human thought which gets converted into computer code. And the great thing with that is I can cover the whole market within a very short space of time, and it's consistent. So I'm looking for signs of stocks which are trending higher, which are showing the signs of being an uptrend. And then what I'll do, I'll send those ideas out to the members of my service each afternoon. And some days there'll be no signals, some days there'll be several. All depends what the market does. And it's not about being right all the time, but it's about consistently applying an approach. And you've got to have that exit point as well, and that's another big part of it. It's like having that predefined exit point. If an idea doesn't work out, well, close out the position and you move on to the next one. If it does work out, you let it run, because some of them can run a very long way. So it's also about having many relatively small trades rather than a few big ones. So it's not just about telling people what to buy and when to sell. It's also explaining the process and telling them how to do it. It's about sharing. It's about sharing ideas. So I really want people to be able to take the process on board and make it their own. Because look, at the end of the day, that's what every great trader does. Because no one's born an expert trader. It's something we all learn. I learned from my mentors. They learned from their mentors. And that's kind of what I do in my weekly report. I'm taking that knowledge and I'm giving it to others who are trying to learn their own way forward and learn how to approach the markets, as well as, of course, the big thing a lot of people come for is the ideas, the algorithmic scans across 2,000 odd stocks, and finding some of those those fascinating smaller stocks which nobody knows their name until they, of course, get a lot bigger, and hopefully they're the ones which people get some money into. And where can people find you? I've set up a landing page for your listeners, Phil, at motiontrader.com.au/shares for beginners. And you can register for people can register for the free 4-part video series there, which will take, the ideas we've talked about here, a whole lot further with lots of examples as well. Okay, Jason, thank you very much for joining me today. Phil, thanks for having me on board. It's been great. The company and or guest has contributed to the costs associated with producing this episode of Shares for Beginners. Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.